Before you buy U.S. Treasury bonds, it is important to recognize that several factors directly affect the market value of a bond. Consider these bond characteristics before you decide whether buying a U.S. Treasury bond is a well-founded financial decision. 1. Face or par value. This refers to the amount of money a bondholder will expect to receive on the bond's maturity date. In case of newly issued bonds, they are available at face value. By default, U.S. Treasury bonds have a $1,000 par value. Now let's get this straight. Face value is not synonymous with bond price. Face value remains constant, but the bond price goes up and down due to a host of reasons. Therefore, there will be occasions when bonds will sell at discount, below face value, and times when they will sell at a premium, above face value. Number 2. Interest. You may hear the term coupon in bond investment lingo. This also means interest. This is the fixed percentage of the bond's face value, and the government pays it to the bondholders semi-annually. Number 3. Maturity. This is the future date when the issuer will repay the investor's capital. U.S. Treasury bonds normally have a maturity date of more than 10 years. Therefore, they pay higher interest rate than other instruments such as T-notes. This is because long-term bonds are more susceptible to price fluctuations than short-term bonds. Number 4. Yield. This is the amount of return that an investor is supposed to get from a bond. If you were able to buy a U.S. Treasury bond at their face value, the yield will be equal to the interest. Here's the kicker. If the bond's price fluctuates, so will the yield. For example, if you were able to buy a U.S. Treasury bond with a 10% interest rate, a $100 coupon for a $1,000 bond at face par value, then the yield is exactly 10%. Assuming that after a year the bond trades at $1,200 because perhaps the newer bonds have lower interest rates, the yield goes down to 8.33%, $100 on the coupon price for a $1,200 bond price. Conversely, when the bond trades at a discount, the yield goes up. So it all adds up to this. Bond price and percent yield are inversely proportional to each other. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Are you considering U.S. Treasuries as an investment? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get more free financial education videos.